What if I told you that starting March 2026, up to $800 could quietly disappear from your bank account every single month, automatically, without a phone call, without a signature, and without you being able to stop it? Sounds unbelievable, yet Canada already has systems that allow government agencies to withdraw money directly from citizens today. The real question is not if it's possible, but how far it could go. Over the past few months, leaked policy drafts, viral documents, and financial law changes have sparked a disturbing conversation online. People are asking, is this just fear-mongering, or are we missing something hidden in plain sight? Because when policies are framed as temporary, automated, or for your benefit, most people don't notice until the money is gone. Stay with me, because by the end of this video, you'll understand 10 real mechanisms that could make this happen, and why millions of Canadians might not see it coming at all. Number 1. Expanded CRA collection powers. First, most Canadians don't realize that the government already has the legal ability to take money directly from your bank account under certain conditions. The Canada Revenue Agency doesn't always need a court order to collect what it believes is owed. Through existing laws, the CRA can issue a requirement to pay, forcing banks to send funds straight to the government. This is currently used for unpaid taxes, benefit overpayments, or compliance issues, but the system itself is already built, tested, and operational. Second, what makes this especially concerning is how easily the scope of these powers can be expanded. A small legislative update, a new compliance category, or a redefinition of what counts as owed money could instantly widen who falls under automatic deductions. History shows that government collection powers often grow quietly during economic stress, emergencies, or policy shifts. When enforcement becomes automated, human oversight decreases, appeals slow down, and deductions can happen before you even know there's a problem. Finally, if a fixed monthly amount, like $800, were ever introduced under a new levy, adjustment, or compliance rule, this system will be the most efficient way to enforce it. No paperwork, no manual approvals, just recurring withdrawals labeled with vague descriptions that most people wouldn't question right away. The people most affected would be self-employed workers, gig earners, and middle-income Canadians, because their finances fluctuate and are more likely to trigger automated reviews. By the time you notice, the process to dispute it could take months, while the deductions continue. This is why understanding how these powers already work is critical, because systems don't need to be invented, they only need to be repurposed. If this made you pause for even a second, drop a comment with your thoughts. We read everyone because these videos take serious effort. And please subscribe to the channel. It's just one click, and it helps us keep exposing what most people never hear about. Number 2. Digital ID and banking integration. Unlike the past, where government records and your personal bank account lived in separate worlds, Canada is rapidly moving toward fully integrated digital systems. Digital ID frameworks are designed to simplify access to services like taxes, benefits, healthcare, and banking verification. On the surface, this sounds convenient, but when identity, income data, benefits, and bank accounts are all connected through one digital profile, it creates a system where financial actions can be triggered automatically, without human review. What most people don't realize is that once digital ID is linked to banking infrastructure, consent often becomes implicit instead of explicit. Instead of signing a form every time, authorization can be buried inside terms and conditions you accepted years ago. If a new policy, levy, or adjustment is applied to your digital profile, the system doesn't need to ask again. It already has permission. That's how deductions can shift from being requested to being executed by default, especially when framed as compliance, verification, or correction. More importantly, digital integration removes friction, and friction is what normally protects people. When systems are slow, humans ask questions. When systems are fast, they just act. If an algorithm flags your account based on income patterns, benefit usage, or policy changes, deductions can begin instantly while notifications come later. This disproportionately affects working professionals, dual-income households, freelancers, and anyone whose income isn't perfectly predictable. You may not receive a warning, just a quiet line item on your statement. And when everything is automated, Fixing errors becomes a process measured in weeks or months, not minutes. Digital ID doesn't need bad intentions to cause harm. It only needs speed, scale, and silence. If this section raised questions, write one word in the comments that describes how you feel. We read them all because these videos take real effort. And please subscribe to the channel. It's just one click, and it helps us keep breaking down what others won't. Number 3. Temporary emergency levies. Historically, governments have introduced emergency levies during moments of crisis, economic downturns, public health events, climate initiatives, or national recovery programs. These charges are often framed as short-term, necessary, and for the greater good. The language matters, because when people hear temporary, they lower their guard. They accept small sacrifices believing there's a clear end date. But once the collection system is active, removing it becomes politically and technically difficult. What's rarely discussed is how temporary levies quietly evolve. A fee introduced to stabilize or offset costs can be extended, rebranded, or absorbed into a new policy framework without triggering public debate. Instead of a one-time payment, it becomes a recurring monthly adjustment, justified by updated projections or new targets. When automation is involved, the levy doesn't arrive as a bill. It arrives as a deduction, quietly processed before most people even understand what it's for. In practice, this is how a fixed amount, like $800 per month, could be normalized. At first, it might apply to a narrow group or pilot region. Then eligibility expands. Labels on bank statements stay vague, explanations are buried in portals, and appeals are delayed. Middle-income Canadians are often hit hardest because they earn too much to qualify for exemptions, yet not enough to absorb sudden losses easily. Over time, people stop asking why the deduction exists and start adjusting their lives around it. That's the real power of a temporary levy, not force, but fatigue. When systems keep running long enough, they stop being questioned and start being accepted. If this made you rethink the word temporary, tell us what stood out in the comments. We read every single one because these videos take serious work. And please subscribe to the channel. It's just one click, and it helps us keep making content like this. Number 4. Universal Basic Income Offset Systems. At first glance, universal basic income programs are presented as financial relief, a safety net designed to help people manage rising living costs. But what's often left out of the conversation is how these programs are funded, adjusted, and recovered. Many UBI models don't just give money. They also include automatic offsets, meaning the government can reclaim funds from people it believes no longer qualify. Once these systems are in place, deductions can happen quietly in the background. What makes this risky is the way eligibility is calculated. Income thresholds, household data, benefit stacking, and employment changes are often tracked through automated systems. If your income fluctuates, even temporarily, the system may determine that you were overpaid and initiate recovery. Instead of sending a bill, the adjustment can be spread out as monthly deductions, framed as corrections rather than collections. To the system, it's math. To the person affected, it's money disappearing with little explanation. Over time, these offset mechanisms can be expanded beyond UBI itself. Once the infrastructure exists, it can be reused for housing credits, climate rebates, childcare benefits, or cost of living programs. Middle-income earners are especially vulnerable because they often move in and out of eligibility ranges. A raise, bonus, or side income can trigger a reassessment months later, resulting in ongoing deductions that feel sudden and unfair. Appeals take time, documentation is complex, and while you wait, the system keeps pulling funds. The danger isn't UBI itself. It's how automated recovery systems normalize taking first and explaining later. When financial help and financial enforcement use the same pipeline, people rarely see the switch coming. If this part connected dots for you, share your honest reaction in the comments. We go through them because these videos take real effort to make. And please subscribe to the channel. It's just one click, and it helps us keep doing this work. Number 5. Unpaid tax and benefit netting. Most people assume that if you owe the government money, you'll receive a clear bill, a warning letter, or at least a phone call. But in reality, Canada already uses a system called netting, where the government simply offsets what it believes you owe against money you're supposed to receive. This includes tax refunds, benefit payments, credits, or rebates. Once netting is approved internally, no fresh consent is required because it's treated as an adjustment, not a collection. What makes this dangerous is how easily errors can happen. Benefit overpayments, outdated income data, or delayed reporting can cause the system to think you owe money when you don't, or that you owe more than you actually do. Instead of asking for repayment, the system can automatically recover the amount through recurring deductions, quietly spread out over months. To most people, it looks like a normal government adjustment, not something worth questioning. The real concern is scale and speed. When multiple programs are linked, tax credits, climate rebates, childcare benefits, housing supports, the government doesn't need to notify you each time funds are moved. It simply balances accounts internally. If a large amount is flagged, the recovery could be structured as a fixed monthly withdrawal, potentially hundreds of dollars at a time. Middle-income households are most exposed because they interact with multiple programs while having variable income. By the time you realize something's wrong, the dispute process can take weeks or months, while deductions continue. Netting isn't new, but when combined with automation, it becomes a silent drain that most people don't notice until real financial stress sets in. If this made you rethink how adjustments really work, leave a comment with one word that describes your reaction. We read them all because these videos take real effort. And please subscribe to the channel. It's just one click, and it helps us keep creating content like this. Number 6. Administrative penalties without court orders. In many cases, people believe that money can only be taken from them after a judge signs off or a court case is settled. But that's no longer always true. Modern governance relies heavily on administrative penalties, which are fines or charges issued directly by government agencies for noncompliance. These can include late filings, reporting errors, missed deadlines, or violations of program rules. Because they're administrative, not criminal, they often don't require a court order to be enforced. What's concerning is how quickly these penalties can escalate. A missed form or incorrect information can trigger a penalty, and if it's not addressed in time, enforcement mechanisms kick in automatically. Instead of sending repeated warnings, the system may simply recover the amount owed through direct deductions. From the government's perspective, this is efficient. From the citizen's perspective, it can feel sudden and confusing, especially when the notification arrives after the money is already gone. Over time, these penalties can be bundled, recurring, or reclassified. What starts as a one-time fine can turn into ongoing deductions if the system determines continued noncompliance. For self-employed individuals, small business owners, and gig workers, people who file frequently and manage complex paperwork, the risk is significantly higher. A single administrative issue can snowball into months of withdrawals before it's resolved. When enforcement is automated, there's little room for explanation before action. The biggest shift isn't the penalty itself, it's the philosophy behind it. Systems are increasingly designed to collect first and resolve later. And once that logic is accepted, recurring deductions become not only possible, but normal. If this section surprised you, tell us in the comments what part you didn't know before. We read them all because these videos take real effort to produce. And please subscribe to the channel. It's just one click, and it helps us continue this work. Number 7. ESG and carbon compliance models. In recent years, governments and financial institutions have increasingly aligned policies with environmental, social, and governance compliance, often shortened to ESG. These frameworks are designed to encourage responsible behavior by tracking emissions, energy use, and consumption patterns. While this is usually discussed in corporate terms, similar models are being tested at the individual level, especially through carbon credits, rebates, and usage-based incentives. What rarely gets attention is enforcement. Incentives are easy to advertise, but penalties are harder to explain. If a system determines that certain thresholds are exceeded, energy use, fuel consumption, or compliance requirements, the adjustment doesn't always come as a fine in the mail. It can appear as a financial correction, deducted automatically under the label of compliance balancing. Because these systems are framed as environmental accountability, they often face less resistance, even when they directly impact personal finances. As these models expand, enforcement becomes increasingly automated. Data from utilities, transportation, and digital payments can be cross-referenced to calculate compliance scores. If a correction is applied, it may be structured as a monthly deduction, spread out to feel manageable but persistent. Urban residents, commuters, and middle-income households are more exposed because their usage is higher and more visible. The danger isn't environmental responsibility. It's the lack of transparency when financial enforcement is tied to behavior tracking. Once deductions are justified as sustainability measures, questioning them can feel socially unacceptable. That's how systems move from optional participation to mandatory compliance, quietly and efficiently. If this part made you think differently, share your honest take in the comments. We read them all because these videos take real time and effort. And please subscribe to the channel. It's just one click, and it helps us keep creating content like this. Number 8. Federal provincial data sharing. One of the least visible shifts happening right now is how government agencies share data across federal and provincial levels. On paper, this is meant to reduce duplication and improve efficiency. In reality, it means that information about your income, benefits, taxes, housing, healthcare, and employment can flow between departments without you ever being notified. When systems talk to each other, decisions can be made faster, and that includes financial ones. What most people don't realize is that responsibility becomes blurred in these arrangements. If a deduction appears in your bank account, which agency made the call? Was it federal or provincial? Taxes, benefits, and penalties can overlap, and once data is shared, enforcement actions can be triggered by one authority and executed by another. From the citizen's point of view, there's no clear starting point to challenge the decision, only a deduction that already happened. Over time, this interconnected structure makes large-scale deductions easier to implement. A policy introduced at one level can be enforced financially using systems at another. Appeals bounce between departments, response times stretch, and accountability fades. People who receive multiple benefits or who move between provinces are especially vulnerable because their data changes more often and triggers more reviews. When deductions are automated through shared systems, they don't feel like a decision. They feel like a glitch, even when they are not. That's the real risk of data sharing at scale. Once enforcement is distributed, no single agency feels fully responsible, but the financial impact lands entirely on the individual. If this opened your eyes, comment the word clarity if you think transparency matters. We read every comment because these videos take real effort. And please subscribe to the channel. It's just one click, and it helps us continue making content like this. Number 9. Automated means testing errors. As governments rely more on algorithms, eligibility for benefits, credits, and relief programs is increasingly decided by automated means testing. These systems analyze income, household size, employment status, and financial activity to determine who qualifies and who doesn't. On paper, automation is meant to be fair and efficient. In reality, it often struggles with nuance, especially when people's lives don't fit neatly into fixed categories. What creates serious problems is timing and accuracy. Income data can be outdated, incomplete, or misreported through no fault of the individual. A temporary contract, overtime pay, or side income can trigger a reassessment months later. When the system believes you were paid too much or shouldn't have qualified, it doesn't always ask questions first. Instead, it initiates recovery through automatic deductions, assuming the calculation is correct. The most damaging part is the appeals process. Challenging an automated decision takes time, documentation, and persistence. While you wait, deductions often continue because the system is designed to recover funds immediately and sort out disputes later. Middle-income earners and freelancers are hit hardest because their earnings fluctuate the most. To an algorithm, fluctuation looks like inconsistency or risk. Over time, small errors compound into large recoveries, quietly pulled from bank accounts month after month. Automation doesn't need bad intent to cause harm. It only needs incomplete data and unchecked authority. If you've ever dealt with an error like this, share your experience in the comments. We read them all because these videos take real effort to produce. And please subscribe to the channel. It's just one click, and it helps us keep this content going. Number 10. Opt-out windows you never see. By the time most people hear about a new policy, the decision has already been made. What often goes unnoticed are opt-out windows, short periods where citizens are technically allowed to decline participation, dispute terms, or register objections. These windows are usually buried inside online portals, policy updates, or digital notices that few people check regularly. Silence during these periods is often treated as agreement, even if you never knew a choice existed. What makes this especially powerful is how notification has changed. Instead of letters or public announcements, updates are pushed to dashboards, email accounts, or apps that people rarely open. If you miss the notice, the system assumes consent and moves forward. Once the opt-out window closes, enforcement mechanisms can activate automatically. At that point, deductions aren't framed as optional, they're framed as standard compliance. In real terms, this is how recurring deductions can feel unavoidable. The choice was technically there, but functionally invisible. Busy professionals, seniors, and people managing multiple accounts are the most vulnerable because they're less likely to track every digital update. By the time a deduction appears, the response is often, "Why wasn't I told?" But from the system's perspective, you were. This is the final piece that makes large-scale deductions possible without public backlash. Not force, not secrecy, just missed moments of consent that quietly close the door behind you. If this hit close to home, comment "I'd want to know" below. We read every comment because these videos take real work. And please subscribe to the channel. It's just one click, and it helps us keep making videos like this. By now, it should be clear that this conversation isn't really about a single number, a single month, or a single rumor. It's about systems, how they're built, how they evolve, and how quietly they can change the relationship between citizens and their money. None of the mechanisms we discussed are imaginary. They already exist in different forms, operating legally and efficiently, often with good intentions. The concern begins when these systems overlap, automate, and scale faster than public awareness can keep up. What makes a scenario like an automatic monthly deduction believable isn't secrecy, it's familiarity. Pre-authorized debits, automated compliance, digital identity, data sharing, and algorithm-based decisions are already part of daily life. When combined, they reduce friction, remove human checkpoints, and normalize actions that would have caused outrage just a decade ago. Not because people agree, but because they're tired, busy, and often uninformed until the impact becomes personal. This is why awareness matters more than fear. The goal isn't panic, and it's not outrage. It's understanding how financial authority now operates in an age of automation. Systems don't need malicious intent to cause harm. They only need to prioritize efficiency over clarity and speed over consent. When that happens, responsibility shifts quietly from institutions to individuals to notice, question, and respond in time. Whether or not a policy like the one discussed ever happens exactly as rumored, the underlying reality remains the same. Financial power today is exercised through processes, not announcements. Through portals, algorithms, and silent approvals. And the people most affected are often the ones who assume that if something important were happening, someone would clearly tell them. History shows that isn't always how it works. Staying informed is no longer optional. It's the only real safeguard left. Before you go, drop a comment with one word that sums up how this video made you feel. We read every single one. If you want deeper breakdowns like this, watch our previous video and support the channel by subscribing. It's just one click, and it truly helps us keep making content like this.